because of the volatility in the markets, and also lots of emails from people who are worried about their pensions. So welcome one and all. We are now live. We're halfway through February already, and I've had quite a few emails about people worried about market volatilities. Should they be chasing some of the most recent rises in the market, whether in the UK, US, or Europe, and also worries about people and their poor pension performance. That's been a biggie as ever. So, as ever, let me know you can see and hear me. Let me know where you are from, and we are going to get started straight away. I try and keep these to an hour, because there is so much material to cover, and I'm mindful also of your time as well. We will have polls on this, so here we go, and I will publish the results. So for everybody on here, I know it was a bit short notice, this one. Sometimes it's just the way things are. So apologies for that. I will make sure you get a version of this later on as well. So kicking off, remember, it is not a solicitation to buy any stock. It is not financial advice. It is education and information purposes only. If you are all sitting comfortably, let's look at 2026. What's happening right now? Now, what we've done is we've taken data from JP Morgan and Goldman Sachs and put it in with our own views. So let me tell you what's going on at the moment. Yes, there is a broadening out into smaller cap companies, and I'll come to the UK, Europe, Asia in a second. So just looking at the US, yes, there's something of a broadening out. Now, that seems to be more justified on momentum and narrative than it does on the data, because nothing spectacular has happened with those companies. When we evaluate companies in the Russell 2000, which are the smaller companies, and we go through and compare companies along the same metrics, which is profitability compared to share price. How much profits are you making? Think of it like renting a property. How much rent are you getting for the purchase price of the property? Okay. Growth, revenue growth, which is sales or profit growth. When we put that all into our algorithm and score it, you can see that, and I'll come back to market cap in a second, you can see that regardless of market capitalization, indeed, regardless of sector or exchange, whether it's London Stock Exchange, you can see there, or NASDAQ, there are just so many which are just not good enough. So simply saying, oh, it's smaller market cap, therefore it is a factor, it's a hypothesis on which you want to start investing, is not a smart move. And I'm going to show you some more evidence of that in a moment. None of these, for instance, meet the minimum requirements of sufficient growth, sufficient profitability for the share price. In other words, you're either overpaying for some of these, which increases the risk you're not going to get a good return, or they're not growing, which also increases your risk. When we look at evidence of that by looking at, say, their volatility or their Sortino, which is their average returns and their volatilities, we see that so many miss the mark as well. Now, that's not to say they can't go up in 12 months. Some of them can. Maybe Donald Trump does a tweet about them, but that was speculative. And as you can see, with a 54% volatility, which would give me a heart attack, it is often dross, which has jumped up temporarily. So whilst you will see a lot of narrative at the moment trying to push people into the great broadening into Russell 2000, that's the smaller cap US companies, and they'll say, oh, it's up 6%. That seems to be more of hot money, momentum money, chasing a story rather than something which is grounded in fundamentals. So beware. Traders, they love that. Spread betting firms, they love that because they know you're going to gamble, you're going to move and flip and flop. Yes, the NASDAQ's only up 2%. It's early days. I get worried if you're checking just 3 months in when you're holding portfolios for 12 months, 24 months, 36 months. So watch out for that. Then, of course, there's been this whole capital expenditure skepticism as if the big hyperscaler companies, the Mag 7 companies, are spraying and praying their money and are not answerable to both the board of directors and their shareholders. Okay, it is almost as if the journalists think, oh, they're just spending money and they've got no ability to generate profits. It's become quite a good narrative at the moment, quite a silly narrative in actual fact, whilst there might be some companies historically which have overspent or made some bad deals, and that will always happen. The idea that $700 billion has across the board been spent without any concept of return on invested capital, well, it's probably from somebody who's never worked in any corporation of any kind, where even to requisition a bloody pencil, you've got to justify what the return is for it. So there is panic at the moment being created, of course, by journalists. I know what you're thinking. Surely not. Journalists wouldn't try and create panic in people. Panic sells. It gets eyeballs. It sells newsletters. Okay. It sells subscriptions to newsletters. It sells fund manager retail funds saying, oh, well, you know, we're smarter than everyone else. But at the moment, it's absolute nonsense. It's panic. So your best option, as you will see in a moment, is actually not to panic as well. Jacob, thank you. Okay. Well, if you look at leverage, you'll if you actually look at the balance sheet of the companies, the big ones that we're talking about, then you'll see that in terms of net assets, they have ample assets. The borrowing that the big companies do is because they can lock in, take Oracle, they can lock in borrowing a load of money at about 1% interest. Now, let me give you a classic example. Let's say I go to the bank and say, can you lend me money for the next 20 years at 1% interest? The bank says, okay, Mr. Patel, you've got a good credit line. We'll give you 10 billion. I say, great. And then if I invest that in something, which generates more than 1% in terms of returns, then it was a no-brainer deal. It is just a machine to make free money. So the big issue is, well, can they beat the 1% interest that they're getting? Because these companies have so much in assets, it's very easy to borrow against it at very low rates of interest. Okay. So yes, there is an issue. Can they get a positive return? I'm assuming that if I buy into a company that hits the value growth income, consistently has performed well in terms of high Sortinos, high alpha, whilst that's not a guarantee that the CEO and the board of directors are not about to go mental, it gives me, by looking at the balance sheet, the cash flow and the P&L, and for the recent past, gives me some degree of confidence. But just to be on the safe side, I make sure that they're undervalued. I make sure that they're growing. I make sure they're not the only one I've put all my money in. But I have 20 companies, let's say, with 5% in each, or 40 companies with 2.5% in each. That way, even if one of them blows up, or two or three, I'm still diversified because I've got more than one company going mental. Now, if I still doubt that the AI thing is not real, it's very simple. If in doubt, leave it out. Go find something out. There are ample companies when we go through our database, and that's why we go through 10,000. If somebody said, well, actually, Alpesh, don't give me anything which is other than retailers, industrial engineering, ignore software and computer services, Alpesh. I want construction and materials. I want precious metals. I don't want electronic. I want the old economy. Well, that's fine. We can easily do that. That's why we need 10,000 companies. For anybody on the Great Investments Program, none of these companies meet our criteria, so don't have a heart attack. I've shown the crown jewels. So what else have we got? Well, the AI productivity trade is moving beyond the so-called picks and shovels, right? The idea with .com was if you bought Cisco, they were making the picks and shovels for the internet to enable everyone else. What's happening now is we're already moved beyond that. Now it's impacting everybody. Chipotle is a classic example, the high street fast food chain. They used AI to improve their supply chain and so on. So everybody is an AI company. Walmart, Costco are all AI companies everywhere. Certainly by the time they're of this scale and listed on a major exchange like the London Stock Exchange, New York Stock Exchange, if they're not already AI, then they wouldn't have got onto that exchange to begin with. One way or another, they're going to be using it. Okay. So don't get over excited about AI. Equally, don't get overly cynical either. Right. So in terms of valuations, market impact and valuation reset, actually, when you look at some of the numbers, yes, there is an argument for going into South Korea or Nikkei, but how much are you going to do in foreign countries? And we'll look at those in a second. Gold, 5%. Maybe you want to be in Japan or South Korea at 5%, 5%. Okay. Now, you're never going to put all your eggs in one basket because that would be stupid. So the person who says, I'm going to have a punt on XYZ would necessarily have to put less money into it. Just as if you go to Vegas, when you know you're gambling, guess what's the first thing you do? You put very little money on a gamble. So in actual fact, your risk is already naturally reduced. It's just human nature. So in that sense, when people say, oh, give me the hot tip, it's like they're saying, give me the accelerator pedal, but I'm going to put the brake on at the same time. The point being, if you do get excited by something, well, you're only going to expose yourself to 5% of it anyway. So let's look at some of the things we might want to get excited about, but also temper that excitement with the fact that we're going to have a balanced portfolio of 5% in each, or 2.5% to 5%. If you have less than 1% in something, what's the point? Because if it does really well, you're not going to gain from it anyway. One of the most important things we're seeing at the moment is earnings are growing 11% year on year, significantly outpacing the 7% consensus forecast. Earnings are profits. Unlike .com, when I used to do my Bloomberg TV show during the .com era, I'd talk about how, well, there's no profits. So let's ride momentum. Let's know what we're riding. When the price goes up, it's momentum. It's not profitability. And momentum can switch. At the moment, what's riding it is, yes, momentum, yes, profitability, yes, revenue growth. So there's more substance to it. When we look at their balance sheet, cash flow statements, and P&L, and remember, companies only have three things: balance sheet, cash flow, and P&L. And when we look at all of those, that's what we're seeing. Okay. Now, one of the other things we're going to talk about in this webinar, I'm going to go back to the stock market in a second, is the number of emails I've had about pensions. Okay. Yes, you're with a pension fund manager, despite all this massive growth that we're going to show you and the markets are generating, people are still getting 5%. And there's a reason for that. And I was looking at St. James's Place Polaris just yesterday for a video that I did. They are now sneakily, they're always finding new ways to be sneaky. They are sneakily layering their fees. So what they're doing is the IFA puts you into a wealth manager's fund. The wealth manager's fund then invests in other funds, usually their mates or their in-house ones. And it's the one that they've invested in which is charging fees. They only have to tell you the headline fee. They don't tell you the layer of fees. And then that invests in NVIDIA. So why do they layer it? Well, they can charge more fees. It's really simple. Okay, and that's what's going on at the moment. Hidden, layered fees. They're also doing one of the worst things possible is they're picking from a restricted gene pool. So they might say this is a UK only fund. Well, guess what? There's only 100 liquid companies in the UK. And if you go through a big fund, that fund has so much capital, there's only 100 companies they can pick from, probably about 50. Whereas were you to use your own SIP, you've got 10,000 you can invest in. Okay, you've got total control. So be careful that what they're claiming as a positive is actually quite a negative. And one of the other examples I give, Naomi still used to work for me as my secretary for 2 years after leaving university, part-time opera singer. My secretary left with an English literature degree, worked for me for 2 years, and then joined an asset management company and today manages billions. Okay, not great returns because of all of these reasons. Institutional fund manager sold out to the dark side. Anybody can be a fund manager is what is making the point I'm making. If you want to go into fund management industry, I always tell people, become my secretary. Okay, because that works. Private empowered investors, I think that's a hell of a lot better. It's a hell of a lot better because you haven't got the fees and you've got the agility to focus on the 20 odd companies that you want, 2.5% to 5% in each. That simple. Very much like a Warren Buffett type of approach. Moves away from no managed funds, just individual investments held long enough so he doesn't panic or get bored. And the kind of companies which he says, if they fall, I'll buy more of. Otherwise, I wouldn't go into them. It's really that simple. Okay? If you're going to panic or get bored with an investment, that's not an investment. It's a trade, it's a punt, it's gambling. If it's the kind of thing which if it drops, you'd want to panic sell, it's not an investment. It's a trade, it's a punt. Good luck to you if you want to trade and punt, you're not going to make a lot of money. This is year to date and the biggest themes. So this whole thing that artificial intelligence has got absolutely smacked. Let's have a look, and I'm going to show you some of these on the screen. Just want to make sure I've answered all the questions. Yeah, I'll answer some of the others in a moment. Okay. Hi, Kavita. Now, what I'm going to do, because quite a few of you on here, is I want to go to, so you might say, okay, let's start off with artificial intelligence, and then we'll move to semiconductors. So wait a minute, an artificial intelligence, some of these are taking an absolute whacking. If we take enterprise, now, absolutely, they've taken a battering, but they didn't meet our criteria to begin with. So what do I care? Take Workday, it's down 34% so far this year, because the thesis is that they are software as a service, where you get software and you pay a commission. is going to be dead because of AI. Whether that's true or not, Workday didn't meet our criteria to begin with. SAP, it's down 16%, didn't meet our criteria to begin with. If you look at, say, somebody like Intuit, didn't make our criteria to begin with, 43% down, no bloody wonder. Guess what also falls under Alphabet, which did meet our, which falls under software as a service? Google or Alphabet. It met our criteria. Guess what? It's only down 3%, and it was up 60% last year. So even if in a patchwork like this, we've got companies which are getting battered by a theme in the short term, the resilient companies is what we're looking at. So Alphabet's in there. Microsoft's one of ours. Okay. And guess what? It hasn't fallen as much as the others. And it's the type where I'm now thinking, and I'll show it in a second, I want to buy more of. So that's the worst case of what can happen. Fine, Alpesh. If you do get a sector which gets battered or a theme that gets battered, take us to foundries or memory. Actually, memory is up 41%. Guess what's in memories? Micron. It is one I own because it met our criteria. So the idea is if it meets our value, growth, income, cash flow, Sortino criteria, and the market has a headwind, then it shouldn't fall as far, like an Alphabet, only down 3%. If it doesn't meet our criteria, then it's going to get smashed 40, 50%. Equally, if there's a tailwind, like in memory chips and Micron, for instance, then it's going to be up 40% because it's already meeting a lot of the criteria. Or another one of ours, Western Digital, up 68%. Okay. Why? Well, because if there's a tailwind and favorable noise and news, and it ticks all these, well, guess what? It's going to soar. And if there's a headwind, it shouldn't fall as far. That's called resilience, and it allows you to be calm. In fact, rather like Warren Buffett, we want more things to fall. Actually. Now, you're going to hear a lot of news about, I don't know, uranium. But does that mean we punt and speculate on momentum? No. But what about grains? Okay, let me give you something in grains. The ticker symbol ADM. Okay, ADM, it's up 17%. But is a reason for it being up 17% a reason for us to buy? Of course not. That's punting and gambling, and that's what retail clients do. Instead, you're far better off managing your own portfolio, not giving it to a fund manager, and making sure you tick value, growth, income. What's value? Profitability. Price earnings ratio is a measure of valuation. Is it undervalued? Lots of profits for the share price. Cash return on capital invested, we want that. That's lots of cash flow. So what you've basically got are balance sheet, P&L, cash flow. Croaky takes care of cash flow. Okay, PE takes care of profit and loss account. Okay, valuation can also be measured through the balance sheet. How much assets have they got, or price to book value? The point being that by having growth ticked and value ticked, you're doing what 99.99999. Actually, I don't know any retail fund manager which does that. So why not? Well, because if they've got billions to manage, they necessarily need to create a value fund, a growth fund, a UK fund. But mixing them together doesn't mean you've got a diversified portfolio. It means you've got some stocks which are only undervalued but not growing, other stocks which are growing but are overvalued and going to fall. You've put them together. That doesn't create a diversified portfolio. So that's the problem that people are facing. And it's basically how they're being absolutely screwed. Okay. Now, I didn't know, and I'm not gambling on which of these various themes are going to do incredibly well. That's for journalists to come up with nonsense on. And yes, software's getting better. Enterprise software in particularly has. But why am I not panicking? Well, because if I'm right about the kind of companies we own, and as I said, with enterprise software, we don't have Workday down 34 or Intuit down 43. Okay, we don't have enterprise software companies. You can see it there. You can see it up here, there. There's a lot of overlap between the themes, obviously, because you can be in AI and software, and you could be just in AI and enterprise. The point being that the other safety mechanism we have is we only have 2.5% to 5% in any one stock as well. If we were that clever and we could see into the future in this, we'd have 100% in one company, wouldn't we? But we don't. Neither is Bill Gates or Warren Buffett. Okay, so some very important lessons to you for you to know. You want to tick the value, growth, income boxes, because if you do not, then when the market falls, either broadly or in that particular theme, you will get beaten up. And when the market rises, you'll miss out on it if you don't tick those boxes. Excuse me a second. Excuse me, pardon me for drinking in front of you all. It's just the throat. So let's have a look at market capitalization. Then you've heard this story, and this is what's causing people to panic, which is why I wanted to do an emergency webinar. What they're panicking on is, Alpesh, I've heard that it's gone out of the Mag 7 and going into smaller companies. Well, Mag 7 is 7 companies. Now, I happen to own 6 of those 7, Meta, Microsoft, Apple, Amazon, Alphabet, NVIDIA. But they're not the only ones I own. There's 34 other bloody companies I own. Okay? So I have about 2.5% in each. Now, there might be times when I have more in those big tech companies. But the point is, if you're equally invested across those, what do you care if temporarily, there's always some theme that temporarily is getting battered. It could be market cap, it could be AI, it could be enterprise software. But if you've got a little bit of money in a bit of everything, that doesn't really matter. And the bit of everything which has to tick the box of value, growth, income, cash flow, Sortino. Now, if you look at this year to date, yes, the biggest market cap ones are getting beaten up. Microsoft, as I'm going to show you in a second, is pretty much in my buy zone now. Okay, and I'll come to that, as I said. Now, Alpesh, I thought all the money's going from the big companies into the tiny little ones. Well, I don't know about you, but there seems to be in nano companies a hell of a lot of red. And in micro and small, I don't know, there seems to be a lot. Mid cap, maybe there's a bit more green than there is red. It looks it. Okay, large, largely green. Even the mega caps are more, I don't know what, equal green and red. So the narrative doesn't back up the facts. It's a mixed bag, actually, by looking at just size. Now, what the human brain does is it looks like this and it says, oh, ASML is up 32%, so I will buy it. That's their hypothesis. If it's gone up a lot, I will buy it. Well, that's a pretty poor, untested hypothesis. Equally, they'll say Oracle's down 21, so I will buy it. Both very bad hypotheses. I own ASML, by the way. Okay? And Micron. I don't have Salesforce, which is down 30, but I could have done. I mean, who knows? Let's say I had it and I had something which was down 30%. So what? It's one of 40 companies. The ability to sleep easy knowing you've got quality companies is like hiring a team and you getting some bad news and you saying, I can sleep easy because my team's going to handle it. That's the mental attitude you should have. Now, Walmart and Costco, I generally like. Okay, generally they tick all the boxes. JP Morgan, I own, it's down 4. So what? It should catch up later in the year. Even if it doesn't, guess what? I've got a big team. It's like the Man City team. Lots of people on the bench who can pull the weight. If the forward isn't performing, then I'll sub them. In other words, I've got somebody else on the bench who can perform, so it's not a problem. By the way, Alibaba, if I was looking at a way of accessing China, that would be the way, but it's so volatile, you will panic owning it. You'll just panic and you'll get bored after a while because it isn't generating enough positive returns. Because what the private investor wants is a straight vertical line. Year-to-date world. Oh, Alpesh, I think money's leaving the US. So be it. If it does, fine. Given that I've got 10,000 securities to pick from, some European, all of these, for instance, I've got Taiwan Semiconductor. I've got ASML. Dutch company. Oh, you didn't know that, did you? Okay. The point is, I'm not country chasing because actually I've got very little choice if I just pick on where they're listed. You tell me, is ASML, you didn't know it was Dutch? You probably thought it was American. So there you go. You went and diversified. You didn't even realize which country it's listed on. And does it matter where it's listed in a world which is so globalized? It did matter in the 1960s and 70s when most IFAs did their multiple choice exam to be qualified as independent financial advisors. So what I'm saying to you is, the bottom line of what I'm saying to you is, I can access the world anyway. And if I've got a particular racism or anti-nationalism against American companies, that's perfectly fine. There's all of these others to choose from. Well, you've got a reduction in number that you can choose from, which makes it less likely that you might get it right. You might think, oh, I want to expose to you. I got a client saying that. And I said, really? Well, which one do you want then? If they don't tick the boxes, what do you care which country they have their listing on? Because the assumption you're making is wherever it's listed, it's highly correlated to the economy of that domestic country. Well, we know that isn't the case because the FTSE 100 is at an all-time high, and yet the British economy is barely growing. Oh, yeah, you're right, Alpesh. Where it's listed doesn't seem to make that much of an impact, we thought. In other words, you made a hypothesis based upon an assumption, and the assumption was wrong, the hypothesis wasn't tested, and you messed up. Your way of thinking is completely wrong on the markets. And it's very pervasive because the journalists will keep on banging on and make you think this way. I mean, for God's sake, look at the profession they chose. Journalism, not investment. Okay? There's nothing wrong with journalism. Now, if we go into, you might say, look at Brazil, Alpesh, there's so much there. Well, as long as they tick all our boxes, but I'm not gambling on it because they're listed in Brazil. Okay. By the way, all of these, that's the country of origin. Every single one of these stocks has a listing in, as well as their home country, on the New York Stock Exchange. So wait a minute, is ASML now Dutch or is it American? Is Taiwan Semiconductor American? Is Alibaba Chinese or American? Because it's listed on the New York Stock Exchange. You can go my SIP or ISA. But just because it's a Chinese origin company like Baidu doesn't mean I'm going to automatically buy it. That would be silly. Okay? And I'm not going to chase the hypothesis of some kind of crazy pattern recognition. Oh, there seems to be more green if you go outside a certain size and the letter begins with A. Now, you could probably shove this in AI and say, give me some pattern recognition. And it probably will. But that's a pretty poor hypothesis if you think about it, because it's not grounded on value, growth, income. What do you think investment should be based on? Some kind of crazy pattern of the letters of the alphabet or market cap, untested hypothesis? Or do you think it should be based on P&L, balance sheet, cash flow? Have they got tons of assets, generating lots of profits, growing incredibly, and still relatively undervalued? What about exchange traded funds? Let's dive into exchange traded funds, okay? And year to date. Now, you might say, energy, Alpesh, I understand uranium. Let me tell you, so let's look at euro, okay? For one. The major problem you're going to have with exchange traded funds, and exchange traded funds are pretty easy to, I'm going to try and pull this up. Let's see, funds, euro. Perfect, I can. By the looks of it. So that's the Euro exchange traded fund. Okay. Now, very simple rule if you want to do exchange traded funds. And people assume that they have low volatility. Well, they often have low returns as well. Because if you look at this little puppy, okay, over there, I'm going to see. Okay. Now, basically, if this monthly average price indicator is moving up, it's called the MACD, I'm sure most of you know it, okay, then fine, that's fine by me if it's moving up, okay, down here, and I'm happy to be in, and if it's falling, I've got to be out, and I might get whipsawed and make no money for a while. That's why exchange traded funds are not an easy thing, and they're not one which generally I'm thinking to myself, yeah, fill my boots, look at that, boredom. 4 years of nothing. And you might say, well, how did you catch this? Well, if you were using the rule I just mentioned with this falling, you're out, then you're out for a very long period of time. And if it's rising, you're in. And then if it's falling, you're out. If it's rising, you're in. And sometimes you might have to go in. Then you find yourself going out again pretty quickly. Out, 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 in. Okay. With any exchange traded fund, that's probably a better way, an easier way, a simpler way than any narrative, any story, than anything else. However, you're going to have to make sure you get your return. So that went from about a 25 to a 52. That's 100% return. Great. Just keep an eye on that and scan through them all. Okay? By the time it shows up here, it might be too late. That's your exchange traded funds. I could probably do that same exercise for every single one of these, but there's too many. So you can do it for yourself. Okay. Oh, Alpesh, what's also caught my eye is EWY. Okay. EWY is, guess what? South Korea. There you go. That's rising. You want to be in. If it's falling, you want to be out. So you want it to be out during all this period, and then you want it to get in. And guess what? You can be in for a long time, and still it doesn't work. Nothing's guaranteed. Look at that. You were in, and you got nothing to show for it. And then it made up for it there. So the point being, nothing's guaranteed. It's just probably better than any other way to date. I am not going to punt and say to you, go into US mid-caps now, go into technology, shorting, or oil, or crypto. Because honestly, the best way we've ever found is look at where the money's going, and the best way of where the money's to find out, where the big money's going, not what people are talking or trying to guess ahead of time. Where's the money going? And the money going shows up in the price moving up, supply and demand, and that shows up in average price movements. And better than anything else, although not guaranteed always to work 100%, is then just looking at that direction. That works only with exchange traded funds, and that's simple. Okay, we're done. Sorted. If you learn nothing else from this webinar, then you got that. Okay. You can add volume if you wish. I keep my life very simple. I'm a very simple man. I don't tend to look at volume on top of it. You can complicate it with astrology as well if you wish. Okay. Now you might say, don't like it, Alpesh. Don't want it. Don't like it. Fine. Perfect. Then don't do it. If in doubt, leave it out. How much are you going to put in an exchange traded fund anyway? 5% max of your capital. So you're not going to put more than that, because you'd be putting all your eggs in one basket then, wouldn't you? If you put more than that, you're punting, you're gambling. Don't suggest you do it. Call can be good. You can see it down there, QUAL. Call can be good. Boring, slow and steady, dull. Okay, it stands for quality. It's an ETF. We've had it in the past for people, and let's have a look. There's your qual. Okay. And if you look at qual, great. When this is falling, be out. When this is rising, be in, out, in, out, in. Okay? You're not going to get out you're not going to get in at the bottom. You're not going to get out at the top. You're not going to be in for the theoretical maximum. That's probably your best way of doing it. Guess what? Most people will fail because they don't have, like me in the gym, they don't have the time, energy, persistence to spend that kind of time. So then what's your best option? You're only going to put 5% in anyway. Well, for me, it's generally individual stocks. But if you do insist on having some ETFs, that's perfectly fine. Just make sure that when you have them, you do project ahead. Okay, you do project, let's say, whenever you get in, when did that start rising? It was quite late, actually. It was only up here. It started rising, I'd say, around there. Okay, what did that give you? 15%? Just make sure that you're happy with the duration and the projection forward, that you're getting the kind of return you want. Otherwise, it might look like it's rising loads and you end up with 10% after 50 years. Okay. Similarly, you're never going to get the theoretical maximum. Let me make that point really clear to you. Okay. What was the theoretical maximum? We might arguably say the theoretical was this, right? That's your theoretical maximum, which was about 75% rise, right? From October 2022 to 2025. So 2.5 years. And you got a 75% rise. That's great. You're not going to get that unless you've got witchcraft on your side. Because even if you use the approach that I've suggested rather than reading narratives, so if somebody said to me at the moment, would you buy it? I said, well, it's a bit overbought here. If you look at what it did last time, it might have a bit more to go up, but don't be surprised if it pulls back. Whereas when it's at the bottom and here, that's why you've got to go through a lot of securities. Because if you look at one, you could be waiting 15 years for it to give you essentially an entry timing. That's why we have to go through 10,000 and 6,000 exchange traded funds. Otherwise, we won't find enough opportunities today. It's because we might miss the boat on some of these. All right. So let's look at the S&P 500 and where we are. Well, I'll tell you exactly where we are. It's the most popular question I'm ever asked. Look at that. Look at the moving average there. Okay. The moving average convergence divergence. That's the S&P. Is it about to fall? Well, it's doing exactly what it did in January 2025. And the first thing that happens is if the MACD falls, okay, sorry, if the price falls, but the dotted green line isn't falling, I call that a baby bear. You'll have heard me refer to that. If the green line starts falling and the price is falling, I call that a baby bear. A mama bear. And if the green line crosses below its own moving average, which is the blue dotted line, we call that a daddy bear. So what do you do in those scenarios? There you go. Take a picture. That's what you do. That's what you do. And the pros and cons of each are there. You could just do nothing, in which case you might be holding on to a deep loss for a long period of time. You could exit on a mummy bear, which you might be a premature exit. You could exit on a daddy bear, in which case you might have lost some of the gains and it has a V-shaped recovery and you end up buying back more expensive. I've got one client who has leverage and is always on holiday, constantly. Every time I speak to him, he's on bloody holiday. And whenever he's on holiday, there's a bit of a mummy bear or a daddy bear. And then the one time he decided, well, I better exit because it was leverage, 2 times leverage exchange traded funds, because there was danger of catastrophic loss for him. This was this time last year. Of course, it was V-shaped. And he said, I wish I held on. Well, yeah, but you're the one who was crying at the massive losses you were having. So the point I'm making is there's pros and cons to everything. Obviously, there's no sure thing. So you base it upon this, your psychology at the bottom there. Okay, it's what we teach our clients. And most people find that they don't have the time, energy, or ability to exit on mummy and daddy bears because they're not trading and they can't do it. So they should just sit it out. That's why we try and pick resilient portfolios. Now, I will, again, as I did in 2022, if it goes into a daddy bear and I go into cash, I will let you know. But it might be like it was last year, a V-shaped recovery, and I end up going into cash and buying back a bit more expensive, but that's the insurance premium I've paid. I don't mind. Just because I buy an insurance premium and my house doesn't burn down doesn't mean I wasted the insurance premium. Or I've got life insurance and I don't die doesn't mean I've wasted the premium on the life insurance. So similarly, I might exit if that happens again and at the risk of buying back more expensive, or I might exit and I buy back cheaper. As happened then, I don't know which of those 2 scenarios is going to happen. There's only 3 scenarios which are going to happen this year. Either the market keeps going up, scenario A. Scenario B, it drops and has a V-shaped recovery, 14% to 20%. Well, I guarantee you 14% drop is going to happen because statistically it does. Okay. Or scenario C, which happens less frequently, it drops 25%. Okay. I don't know which one. Gamblers will gamble on A, B, or C. I'm not a gambler. My portfolio, if it keeps going option A, will keep making me money. If it goes into option B, it'll drop a bit and then rebound and be resilient and not drop so far. So I'm fine. When it goes into option C, well, we'll see when it happens, go into cash, in which case it'll be a year where I make nothing because I'm holding cash. But at least I won't be making big catastrophic losses. So there's a plan. It's very simple. And if you wanted, you could do none of those things and just hold on, see it through. Now, your IFA or wealth manager or your St. James's Place, whoever, will never, ever, ever tell you to go into cash. They claim they will. They say, no, you don't understand what we do. We really look after our clients and we do tell them when they should just hold cash. Bullshit. They've never done it in their history in the last 40, 50 years. They'll only tell you to hold cash if you're 1 year to retirement. They'll say, yeah, hold cash or hold more cash. Obviously. But they won't tell you to hold cash because they think that the market, well, they don't think at all anyway, because the markets are falling. And that happens once every 5 to 6 years. Do I think it'll happen this year? Probably not. This happens once, well, you look at it. How frequently? 1, arguably 2, 3 times in 6 years, 7 years. That happens once in 7. But these deep V-shapes happen once or twice in 7 years. And the baby bears happen, I don't know, 5, 6 times a year. And the mama bears happen, what's that? 1? Well, that's the mama, but she became a daddy. 2, okay, yeah, 2 or 3 times. So most of the time I'm doing nothing. There's nothing for me to do. Past week, well, everybody's been trying to scare the bejesus out of the big companies. But look, there's ample money elsewhere sloshing around. And it's not tech. I mean, you tell me, why did JP Morgan fall or Goldman Sachs? It's got absolutely not. Or Wells Fargo, Bank of America, why did they fall? Or Citigroup, 8%. It's got nothing to do with AI. So there'll always be a reason. Don't let 1 week's noise put you off. Equally, don't try and gamble on one single security. You'll have a lot more peace of mind when you put 5% in each than trying to put 50% on any. I did not know, as I've said time and again, that Alphabet would go up 62% and Microsoft would actually fall. If I knew that, I would not have mentioned Microsoft. I would only have mentioned Alphabet. Why have I got shares in both? Because I didn't know which one was going to do better. Why have I got NVIDIA when I've also got Goldman Sachs, which did better? Well, because I didn't know which would do better. In fact, I would have put my life on NVIDIA doing better than Goldman Sachs, but it didn't. Okay. But what that also tells me is, given the amount of profits that NVIDIA makes, and Microsoft makes, and Apple makes, and Amazon makes, that their balance sheet has suddenly make them really cheap companies, because they've taken all their profit and loss, their profits, moved it into the balance sheet at the end of the year, and the balance sheet assets now are even making the company look even cheaper because the price has actually fallen. So the price to book has dropped, yet they're profitable as hell. Wow. But that's not a reason to buy. It's hypothesis we're testing. The reason to buy is that value, growth, income, cash flow. So you see why when students or anybody doesn't tick these first 5 boxes, they're gambling and they're punting. Because they're actually, it's like me. I once played Baccarat. I don't know if you've ever played Baccarat at a casino. I had no bloody idea what I was doing. Okay. It was $2 or $5. I don't know, $10, maybe even as much as $20. Okay. And that's not code for 20 million. Yeah, it really was $20. Because I always wanted to play Baccarat. That's how most people play the stock market. Walking by and thinking, well, I'll have a bit of that, but that sounds good. I saw it in a James Bond movie once. I'll have a bit of that. That's how most people invest. We've got to stop you doing that. Otherwise, what you then do is give it to a bloody fund manager who messes it up for a whole different set of reasons. FTSE 100, well, as we've been saying every single week, and to my ever-continuing surprise, it has done something which it hasn't done in decades, which is, see, normally when it gets to this point, it normally turns down. Okay, so the price turns down most times. 4 times out of 5, okay, it will turn down. Now, as we said, because we've been following it all the time, if it breaks through, which it has and continues, now I don't know how long that's going to last, but I would have expected that kind of pattern from the US markets because of AI than from the UK because of the price of gold and banking companies, and because people are looking for non-US. So is that on momentum? Well, you tell me, is gold momentum or value-based? Well, you can't get profits from gold in the sense of it doesn't generate dividends. So that's a momentum play. And a very simple momentum play, as I said with exchange-traded funds, is if this puppy is rising, feel free to be in. If it's falling, I'd say you'd want to be getting out. The point more sophisticatedly put in those terms. Very, very straightforward, keeping it simple, because when it's complicated, people mess up. So let's look at Microsoft and what's happening to a lot of the big tech companies, because it's causing people a lot of panic. I'll answer the questions in a second. What is your MACD? The same one, which is default on all the softwares. All the softwares everywhere in the world have the same default setting. And the reason for that is that's the original setting created by Gerald Appold on the MACD. Okay, so don't worry, don't complicate your life. Now, and it's monthly. Okay, now you can't. Now, the mistake people make is they go and then use it for everything. They'll go and use it for. You can only use it for exchange traded funds and what I call the Quality 5 Plus. Right now, Microsoft. Now, this is happening a lot at the moment with companies. I happen to own it. Well, it's one of the Quality 5 Plus, and we know when there's a daddy bear, you might want to get out of town, but if you don't, you're usually okay. Like here, as I've been pointing out. So first you got the mama, which we've pointed out. Then you got the daddy, which is when it crossed below, okay, which was just in here. And then, of course, it continued lower, and it will continue lower. Okay, it might do this, and it might do this. We don't know. Is it going to be option A, as it did here, i.e. short and sharp, or option B? And if you don't like it, you don't have to own the stock at all. Now, one thing we know about Microsoft, which is interesting, is this. It's return histograms over a period of time. When it gets to down 23%, roughly we're here at the moment, tends to be a buy the dip. Now, that in itself is a hypothesis, but is not the only reason to buy. Value, growth, income, cash flow, Sortino, alpha, all of those other things. Plus, that's a nice little thing to know. Okay, but I wouldn't really be going into it until I see this flatten out a bit more. This flatten out, this sort of start rising. as it did there. Now you might say, well, wait a minute, that means you were going to miss out on the bottom. Yeah, I'd rather get in late than get in early. General rule. I'd rather get in late than get in early. Getting in early could mean getting in here, here, here. Getting in late means once and done. All right? Never want to get in when this is falling. Simple as that. So that's where I'm on Microsoft, which is I'm happy to either have sold it at a daddy bear and bought back more expensive. I didn't do that. Could have done. Still within the rule. Look, I could have done 1, 2, or 3. It's up to me. See? It's up to me. And for me, nothing hurts me. That's why I did that one. Right? But there's another reason. I like the company anyway, and I'll buy more of it potentially. But look, you're all going to go away and think, right, that's it. Wifey, go call the bank. We're going to mortgage our house and put it all in Microsoft because Alpesh said so. Obviously not. You're only going to probably have 5% of your portfolio in there anyway. And if in doubt of anything I've said, don't do it. And that's the other point I want to make to you. You got to think portfolio level, not individual stock level. The biggest mistake people make very often is they're thinking individual stock level. So an individual stock drops and all of a sudden they're absolutely panicked. Okay. When you put together a portfolio, take this, of 20 to 40 securities, yes, everybody's excited about this, but actually what you should be looking at is, can you withstand that drawdown? And now at the portfolio level, that drawdown will be less than probably any individual stock in the portfolio. Individual stocks will drop as much as 75% in that portfolio. Private investors make the mistake of trying to be right on every single security. I'll give you an example of that portfolio. Okay, that's that portfolio. And notice how, and these are the stocks at the top. Okay, whoops. These are the stock names here. Now, notice how some stocks can be down 40% in a year. And yet that's a portfolio which has been compounding at 32%. It's mental. Okay? And we're not talking changing names. We're not talking trading. That's the same bloody name since 2013. And we're not talking, oh, well, you must have punted on one company. No, count them. Okay, there's a whole bundle of them. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, 23 companies. Okay, it's 23 companies. So you've got less than 5% in each one. And, oh, but no, Alpesh, it did well because you had one company which made all the money. No, that's not the case. If you look at those numbers, one company didn't do it. Oh, so you traded? No. One company? Nope. Concentration risk? Nope. Tiny little company? Well, no, the S&P is hardly a bloody tiny little security, is it? It's a freaking index. Arthur J. Gallagher is one of the massive companies. Oh, it's because you just got lucky and every single company went up every single year. Nope. As you can see there, none of them did that. Not a single one of our companies on there went up every single year. Oh, it's because none of them fell too far when they went down. Are you kidding me? Look at how many have had I think every single company had a double-digit fall. Every single company since the portfolio was created had a double-digit fall. Tell me I'm wrong. I'm looking at it now. Every single company had a double-digit fall. Bloody hell. It's pretty shitty. I'm going to put a portfolio together with you where every stock has a double-digit fall over a 10-year period, but it's generating 32% per annum. Oh, no, you cherry-picked historically. No, because if you bloody cherry-picked historically, you'd hardly pick companies which were down 54%, would you? Or 39, or 64. Do you see what actually, when you lift the hood, and no IFA ever does this. Well, first of all, they don't understand it themselves, so they can hardly educate anybody else. I mean, I don't know if you've read this book that I wrote with Paresh, Simple Strategy of Highly Effective Traders. Okay, we put hedge fund strategies in there. Another book that I wrote, Investing Unplugged, reviewed by hedge fund managers, because we took all the academic research from all my FT columns and academia to show people this is what actually is involved. So when we had our portfolio last year, one of many, because we can pick a new portfolio every single bloody day if we want it, because we've got the data. Okay, you can say pick a Thursday portfolio for 12 months, pick a January one, January to January, February to February, March to March, April to April. Okay, any 12-month period. one, but calendars people like. When we went through all of this and had the January one, 2025, we didn't know, and I keep saying this to people, and yeah, it's really important, that Filtronic would go up 142%. If we knew that, we would have put all our money in that. That's why in a tailwind, we were lucky there was a tailwind because it was out of our hands, so we were lucky. And we got 58%. We didn't get 142. But there was a tailwind out of my hands. Was that good luck? Yeah, it was good luck. There was a tailwind. If there was a 2022 kind of year, we would have had 0%, as we had in 2022, 0%. Liz Truss was Prime Minister then, by the way. We also lost the Queen. It's a bad year, that. I didn't know Jabil. Well, does that mean you'd still have it? No. The way you answer that question, my friend, is this. That's how you answer that question. Okay? Does it tick all those boxes? Remember, just for clarity, only use this for ETFs or indices or one of the quality 5 stocks, not otherwise. And I tell you right now, you will not have the mental capacity all the time to use mummy bear and daddy bear rules. You just won't. You don't have the time. Okay, I might as well tell you. Look, if I work for Virgin Gym and I was trying to sell you gym membership, I'd say, yeah, you'll be fine. Come join the gym. The truth of the matter, we all know, data shows 99% of people don't do it. You won't do it. These are some of the portfolios. Why are they varied? Well, because some clients want less drawdown, because even though they know they're holding for a longer period, and they're always made bespoke for clients, that they can't hold on that long. Okay? This I've covered in the past. I'm not going to go through all of that again. So what I want to talk about is, before I go on to this bit, is I want to take you to what's happening with the markets at the moment. Let's just go into all of that, what's causing people to panic. Right? Now, look at that. Here's Wednesday's biggest calls. Wednesday, today. Well, of course, they've got to say that. They've got to say that because they've got eyeballs and advertising to sell. So they've got to keep feeding you with more and more news. Armshares edge higher in pre-market as Nvidia shake up sits AI bets. Fine, great. That's not a reason to buy. That's the problem. People will then go and buy off the back of that news story without testing any hypothesis, without saying value, growth, income, cash flow, Sortino. Just because Garmin's up 12% isn't reason to buy. Might be a reason to do more research, or Palo Alto Networks is down 7%. Might be, or Charles River, to do more research to see is there something there. But I'd rather than single stocks, because there's 10,000 of them, I'd rather see where they are on here. And yes, I'm holding for 12 to 36 months because a day is too short, obviously. Okay. The temptation will always be to trade. I suggest you don't try and trade unless you're trying to be a trader. Okay. Cadence is one we've liked in the past. It can be a bit volatile. The fact that it's up 8% today, I didn't know, couldn't care less. Because we've got to look at the company in the whole on the portfolio level. And that's the mistake people make. Now, I came about all of this and wrote about it in my Financial Times columns because basically I just took from 3 economists, Eugene Fair-Medal, Kahneman, and Richard Thaler. They went on to win the Nobel Prize. We filtered 10,000 companies by Croakey, which comes from Deutsche Bank and Goldman Sachs. 10,000 companies get put down into a portfolio of stocks which are resilient enough that we don't panic or get bored. We don't have to panic or get bored. So the journey is a lot smoother. Most people, even if you give them the right stock names, will mess it up because they will panic and get bored. Or they'll look at single stocks, which is what the newsletter writers want you to do. Fund managers can't make you the money. We know that because they pick from a narrow gene pool, because they have so much capital under management, which is why you get such poor growth, because they spray and pray across so many companies. And in years like 2022, they can't go into cash. Okay. Instead, the way we think you should do it is it undervalued? Is it growing? And we're not punting and speculating. You put those ingredients in, you can make your own model portfolio, which we then test the numbers on to see if it looks good, or you take a pre-existing one and maybe tweak it slightly. And the fact, or we'll take a model of models where we've taken cherry pick from models. The fact of the matter is that if you look at it at the portfolio level with quality companies, you get a good night's sleep and your pension is taken care of. If you're a businessman, or you are a professional, cash rich, time poor, dentists, lawyers, accountants, or a business owner, or somebody who's got capital and looking at a legacy, if you clone yourself through your portfolio and then the portfolio is left to keep generating capital, then you've cloned yourself. You've created a legacy for your children. It's growing. Whether that grows at just what the market's doing at 15% per annum, the US market over the last 15 years, which doubles in 5 years, or whether it's doing it because of tailwinds as it's done over the last 3 years, the point is that's taken care of, a bit like your will, your life insurance. And I want more people to take care of it, create that factory and leave that bloody factory alone of companies. Instead, what private investors do is they never set it up. And when they set it up, they keep breaking the factory down every 2 minutes and flipping around and moving it in and out and so on. Okay, so what's the power of compound growth? Well, it's very simple. If you start off with 200, yes, you double it depending on the growth. And one of the best ways I've told people time and again, to understand those numbers, we created completely free tools. We don't even want your email address. Pension calculators, you can rate your existing pension here. It's a great little tool. You can actually rate your existing pension. You can put in who you're with, and we calculate a rating based on my own algorithms. It's all on there. So you can rate. Isn't that great? You can actually rate your own pension. And what's the safe amount you can withdraw? You know, sometimes they say, is 500,000 enough to retire on? How much can I withdraw with this much if I'm going to live this long? Guess what? We created a safe withdrawal calculator, completely free. Don't even want you, and you can play around with it. And that's the other beauty. Unlike an IFA who keeps charging you money constantly for each analysis, you might say, well, actually, I want to do one for my wife, my son, my child. And what if I get more growth? What if I get less? What if I have a more volatile video portfolio? Okay. And that's all on there on campaignforamillion.com, completely free. And actually, if you go to campaignforamillion.com, completely free, you'll be able to download a free copy of this book as well. Completely free. Yes, I said that. Okay. So those are the important things. What we don't like at the moment, which is happening, is people are basically renting advice. What they're doing is they're giving their money and eroding their capital by giving it to an IFA or a crappy fund manager, St. James's Place, L&G, and all the rest of it. And as the years go by, the fees that they're paying just keeps adding up. And they're not getting the growth because we know from Eugene Fama, the Nobel Prize winner's work, 90% of people, 90% of fund managers underperform even the benchmark that they themselves are targeting against. Whereas what we say is, no, one-off. It should be one-off so there's no conflict of interest. So you own the factory, you own the infrastructure, you own the data, you're not renting it. And that way, you've got all the data, you've got all the know-how, you've got all the donkey work done for you, and you're not constantly paying rent to an IFA who underperforms by shoving it into a fund. Instead, you bypass the fund and you own it directly. And by owning it directly, you save a shed load, but you have transparency and control because you decide whether and if to go in or out and what to do. And most times you have to do nothing. And by the way, if you think the big brand names like Fundsmith are safe because they advertise and market, well, we did the maths on it. I've written a whole bunch of articles, 5.8% per annum. Well, that's barely above inflation. Okay, you can again go to campaignforamillion.com. You'll see all the free articles that we've done there. And that's Fundsmith. They rely on their piss poor marketing to grab money into people, from people. And that's the problem. Right, I'm going to answer some questions and then the hour will be up. What did the Quality 5 return in 2025? It was on the screen. There it is. It was only 14. It was 45 the year before, 56, 1, 41, 41. If you wanted more, you would have had that one. They'll all vary. They'll all differ. We don't know which one's going to be the winner in any given year. And by the way, if you want to beat the S&P 500, it's very, very easy. Just do 2 times leverage. If the MACD is rising, be in. If it's falling, be out. Simple. And you'll get even better than these returns. Okay, these returns are all based on buying and holding and not even moving. Okay, simple. So beating the S&P, very simple. S&P 2 times leverage. MACD's rising, you're in. If it's falling, you're out. Very simple. You know, people go, oh, you mean the S&P? Yeah, there you go. So we do it every single year, beating the S&P. And there's the algorithm. There's the evidence. Okay, you can either buy and hold the 2 times leverage, which, as you will know, I do, or you can exit it when the MACD's falling, as I showed you on the charts. Whichever one's more active than the other. Passive, you still beat it. Active, you beat it even more. And that's it. So why do individual portfolios? Well, people like having individual stocks. They don't like index tracking. They could. I could just make their life really easy. They just track a freaking index, will you? The AI picks ones last year did well. So which of our models did really well? If I say over 20% return is really well, then the ones which did really well was our US ETFs, not the UK ETFs. The model ETF UK, UK ETFs optimize did. The AI picks did. The S&P 500 stocks filtered by High Sortino did. The Quality 5 returns did. European did the best. Did I know it was going to do the best? No, I did not. Okay. Everything else, no, this one didn't do above 20, only did 16. That's disappointing. But there you go. All varies in each given period. Okay, what else have we got? Qualified search appetizer. No, Quality 5 Plus are 44 companies, Jennifer. There's about 45 companies in there. Okay. Okay, Mag 7 predictions in the last. I don't do predictions for 3 months. That's trading. So why would I do that? Flip a coin, mate. They'll be up. There's your prediction. Mag 7 will be up in 3 months. Flip a coin on it. Thanks, Jacob. Delighted. Okay, I think that's it, guys. Let's look at number one frustration people have with IFAs. Poor performance, yep. Fees, yep. Not trustworthy, yep. They don't seem to understand what they're doing, hell yeah. Those are all good. All the ones you've mentioned, there you go. They're all true. I'm going to give you some files that you can look at as well. Okay. For those who are interested in the program, I'll put a link up for that as well. If you're interested in the program, you should see some files come up on screen. Okay. And okay, Alpesh, are you around 25th February in London for a coffee? Jacob, if you're a client, yes. If you're not a client, then I'm not, I'm afraid. I need to meet with clients. Okay. Any other questions? Alpesh, could you look at these two ETFs, IWMMU? I might be able to. Do you say IWY? Was it this? Russell top. There's, like I said, if the MACD is falling, I'd want to be out. If it's rising, I'd want to be in. Really simple. Russell's top 100, so I wouldn't want to be buying it now. Doesn't mean I'll capture. That might be the bottom, by the way. I'll miss the bottom. Look, you missed the bottom there. When did you get in? Earliest there. You missed the bottom. That's the approach with it. That's the danger. Okay. You could try it on the weekly, but then you'll be in and out and trading more volatile all the time. Okay. IWIMU. Is MU an ETF? I'm surprised if it is. Oh my God, you're looking at leverage, are you? Oh, which one of these two is it? Oh, ME is just that one. So I guess it's just Micron. Must be wrong. Okay, guys, I'm going to call it a day then. I hope, like I said, if any of you want to be part of the program, then there's a link on there, or go to alpeshpatel.com/shares. If you want to see past performance as well, remember each portfolio has to be bespoke. So go to alpeshpatel.com/shares and you'll see the past there as well. Okay. And we haven't upped the price. Each year, what we do is we look at how much the stock market's gone up and we raise the price by that amount. So we've gone from 1,000 to 25. But don't worry, we haven't done it yet so far this year. We will be doing it this year as well. It's the right thing to do. You're not trying to buy my portfolio because I might have bought it. This is the mistake people make, and that's what happens with fund management. Because today's a different period. I might have bought mine like Warren Buffett has in 1972, and I've got Coca-Cola, which is bought from then and still going on, so that's why it needs to be bespoke. When you're going through a fund manager, you're screwed because it's simply not bespoke. You're just buying into something they've already owned for a long period of time, which just does not make sense to do it that way. Okay. Thank you all very much. So also on alpeshpatel.com/shares, there's some free reports, our 2025 returns and all sorts of other stuff where you see the preview. Please have a look at those as well. I think you'll find that helpful to you all. Any other questions, just email me. If any of you do want to join the program but need a bit of time to think about it, then feel free to email us and we'll reserve for maybe one person who's on here, one or two people on here. But we don't like reserving for too long because then somebody else's spot is gone. Okay, so thank you all very much. Any questions on any of that, let me know. I hope that put the market in perspective, which is essentially don't panic. Yes, some things are falling, but if they're quality companies, it's an opportunity to be buying. Overall, there's strong profitability in the market. There's strong revenue. The only people who are panicking are the ones who bought poor quality companies or just never realize what investing is compared to punting, gambling, and speculating. And if they're punting, gambling, and speculating, they deserve the panic that they're going through and that they're getting at the moment. Okay, that's it from me. Thank you all very much.